Dear friends, in this episode we are going to learn price to book value ratio in share market. So price to book value is a ratio of the market valuation, and it is used for the value of a share to its assets value. Means what is the value of company share and how much asset it have for that valuation. So we can say that a price to book ratio analysis is an important part of an overall value investing approach. Such as approach inherently assume that the market is somewhat inefficient and therefore at any given time companies are trading for significantly less than their actual worth, or sometimes it's higher. A low price to book value ratio is a ratio with lower values, particularly those below 1, could be a signal to investors that a stock may be undervalued. In other words, the stock price is trading at a lower price relative to its value of the company's asset. Conversely, market participants might believe that the company's asset value is overstated. If the company has overvalued its assets, investors would likely avoid the company's shares because there is a chance of asset value with face a downward correction by the market, leaving investors with negative returns. A high price to book ratio is the ratio that greater than 1 suggests the stock price is trading at a premium to the company's book value. For example, if a company has a price to book value of 3, it means that its stock is trading at 3 times its book value. As a result, the stock price would be overvalued relative to its asset. A higher share price versus asset value could also mean that company is earning a high return on assets. However, at high stock prices could indicate that most of the good news regarding the company has already been priced by the stock. As a result, any additional good news might not lead to a higher stock price. There are some limitation or criticism of the price to book ratio. Although the price to book ratio can help investor identify which company might be undervalued or overvalued, the ratio has its limitation. Capital intensive industries, the price to book ratio is only considered useful in practice when applied to capital intensive businesses such as energy or transportation firms, large manufacturers, or financial businesses with a significant amount of assets on their books. Intangible assets. Book value ignores intangible assets as such as company's brand name, goodwill, patents, and other intellectual properties. That means it does not carry much meaning of service based on with 5 tangible assets. For example, the bulk of Microsoft assets value is determined by its intellectual property rather than its physical properties. As a result, Microsoft share value bears little relation to its book value. Debt levels. Book value does not offer insights into companies that carry high debt levels or sustained losses. Debt can boost a company's liabilities to the point where they wipe out much of the book value of its hard assets, creating artificial high price to book value. Asset values. Behind the scene, operating issues can impact book values so much that it no longer reflects the real value of the asset. First, the book value of an asset reflects its original cost, which is not informative when assets are aging. Secondly, the value of asset might deviate significantly from the market value if the earning power of the asset has increased or declined since they were acquired. At the same time, companies can boost or lower their cash reserves, which in fact changes book value but with no change in operations. How to calculate price to book ratio? You can calculate price to book ratios as follows. Price to book ratio is equal to market price per share divided by book value per share. In order to calculate price to book ratio, the following information is needed. Market price of the stock. So you can get the market price of the stock from your stockbroker or from your trading account, or you can also search current market price with Google or Yahoo Finance. Total amount of assets from the balance sheet. You can get total amount of assets from the balance sheet, total amount of liabilities from the balance sheet, total amount of outstanding equity shares from the shareholders section of the balance sheet. First, we need to calculate the book value per share, which is in denominator of the price to book ratio formula. As stated earlier, we know that book value equals a company's total assets minus its liability. To arrive at book value per share, divide the book value by the number of shares outstanding as shown in the formula below. Book value per share is equal to assets minus liabilities divided by number of shares outstanding. So in this way, you can get the book value per share. Now divide the per share value by this book value, you get price to book ratio. Thank you to listening this podcast. This podcast is brought to you by Sandhu Value Investing.